The Federal Reserve makes a big announcement slashing its key interest rate 1/4 percentage point.
Yeah, slower inflation and a cooling job market have paved the way for this. But what will the long-term effect be for consumers? Business reporter Alexis Christoforous is here to break it all down for us. We're always so glad to see you. Explain this to us. So why did the Fed cut the rate, and what does this actually mean, for me?
Right, but that's really what it all comes. What does it mean for Eva? No. Well, look, the Fed finally feels confident that inflation is coming down to that 2% target. This is the second rate cut we've had in 4 years, just to put this in perspective. So they lowered that rate. What that means for consumers is it's going to be cheaper for us to borrow money. The bad news is we're not going to feel it in a big way, at least not right away. And I brought a couple of examples to sort of illustrate this for you. So let's take credit cards, for instance. Right now, the average balance on a credit card is $6,300. If you bake in that rate cut yesterday, the rate's about 20.1%, so still really high. Your savings, a whopping $1 a month. Oh. I told you it wouldn't be a lot. Let's move on to car loans. So $35,000 car loan for 60 months at this rate cut now, after this rate cut at 7.3%. Monthly payment goes from a little over $700 to a little less than $700. Savings there, $4 per month. So I think the takeaway is many interest rate cuts over the course of time will add up. The impact will be bigger, which is more reason why don't take on new debt if you don't have to, and focus on paying off high interest debt now if you can.
All right, the second rate cut this year, but mortgage rates are still going up. So what's the disconnect?
Yes, exactly. It's been a head scratcher for a lot of folks. It's important to remember the Fed doesn't directly determine mortgage rates. It's really more based on what's happening in the bond market. There's a feeling that the economy is growing. There are also some fears that inflation may even come back again. That's what's keeping these mortgage rates elevated. Remember, they did fall leading up to the first interest rate cut from the Fed, and now they're higher. So I want to show you this example. So if you've got a $400,000 home loan right now at the prevailing interest rate of 6.79%, your monthly payment, you can see they're a little over $2,600. You're actually paying $155 more per month than you would have in September before the Fed started cutting rates.
Oh, that does not feel good.
No. And the good news is rates are supposed to hang around here for a little bit, not go much higher, but not go much lower either.
Okay, so if you have to buy a house, you have to buy a house. If you don't, stay where you are.
Yes.
President-elect Trump is preparing to take office. How will his economic plan affect these interest rates? Will it affect the interest rates?
That's the big question mark. We know that he has some aggressive plans to cut taxes. He wants to cut taxes on Social Security benefits and tips. He wants to lower the corporate tax rate. He has plans for these heavy tariffs against a lot of our trading partners. He wants mass deportations. All of these things are going to cost money. Will they mean economic growth in the long term? Will they weaken our economy? Are they going to fan inflation further, which is why the Fed, ironically, now starting to cut interest rates. We could see the Fed pause those cuts and actually start hiking rates in the months and years to come if they believe inflation is being reignited.
And speaking of inflation, it's come down in recent months, but why are Americans still feeling the pinch at home?
I know, and it's true, and it's really troubling because on paper the economy looks good, right? We have inflation coming down, unemployment is low, wages are going up, but people are frustrated with these higher prices, and rightfully so. They feel their paychecks aren't going as far as they used to, and they're not. I mean, we're paying more for rent, groceries, gas than we were just 4 years ago. In fact, the average American household is spending $1,200 more for the same goods and services they were buying in 2020. So the fact is, you combine that with the higher interest rates we've all been dealing with for years now, and it's been a double whammy for consumers. Now, I like what one economist said. He said those interest rate increases took the elevator up, they're going to take the stairs down. That means it's going to be a slow process. You need to have patience, but over the course of time, these prices should start to stabilize.
My goodness, $1,200 more a month. I mean, most people aren't making that much more a month, It's like...
And that's the frustration, and that's what we saw at the polls this week.
Yeah.
All right. Business reporter Alexis Christoforous, thanks for being with us. We
Pleasure
appreciate
as
it.
always.